NVIDIA stock has surged over 880% in 3 years. Global AI investments are projected to exceed $2.5 trillion in 2026. But beneath the surface, cracks are spreading. Welcome to the AI hype cycle, the most powerful and dangerous force in markets today. The hype cycle follows a predictable pattern: a technology trigger, a peak of inflated expectations, a trough of disillusionment, and finally a slope of enlightenment. AI is currently somewhere between the peak and the trough. The trigger came in November 2022 with ChatGPT. Then DeepSeek in January 2025 shook the entire American AI approach. And in February 2026, Anthropic's Claude Opus 4.6-cent software stocks plunging despite strong earnings. By 2025, the hype was in full swing. The Shiller-Cape ratio exceeded 40, a level seen only once before, right before the dot-com crash. NVIDIA and Broadcom traded at price-to-sales ratios above 30, historically considered speculative territory. Market concentration has reached unprecedented levels. The top 10 stocks now represent 35% of the S&P 500, compared to just 25% at the dot-com peak. That means a correction in AI leaders would hit the entire market hard. Perhaps the most alarming disconnect is between spending and revenue. Hyperscalers committed nearly $400 billion in capital expenditure during 2025, while enterprise AI generates only about $100 billion in actual revenue. Yet not everyone sees a bubble. A Bank of America survey found that most investors believe the AI rally is still in a boom phase, not euphoria. Fear of missing out continues to drive the trade. Investor flows are rotating rapidly. According to CoinDesk, hot money has moved from crypto to gold to AI infrastructure and now into semiconductor memory stocks. Bitcoin surged 650% from 2022 to 2025, but momentum has faded. Gold climbed above $5,200 per ounce in February 2026, driven by the debasement trade narrative. But now even that rally is cooling as capital flows into AI equities. Crypto IPOs have stalled. Fundstrat's Tom Farrell notes that weak trading volumes and macro pressures are weighing on valuations, even as AI-linked tech listings boom. AI-themed ETF inflows hit a record $19 billion in 2025, up from $4.2 billion in 2024. Overall, U.S.-listed ETFs attracted $1.4 trillion last year, shattering all previous records. Infrastructure spending continues to accelerate. TSMC announced a record $52 to $56 billion capital spending plan for 2026. The 6 largest U.S. hyperscalers are projected to invest over $500 billion in AI infrastructure this year. Unlike previous tech booms, this rally is underpinned by earnings growth. NVIDIA is forecast to generate $168 billion in 2026. Cash flow projections for major AI players continue to rise. But Moody's warns that even if AI lives up to the hype, it could still leave investors disappointed. They predict the S&P 500 will average only 5% annual returns over the next decade, down from 11.7% in the previous 10 years. Reuters reports that global investors are actively seeking undervalued pockets of the market. Growing concerns over an AI bubble are pushing traders to look beyond highly valued tech stocks. Jefferies equity strategist Stephen Desinctis expects the Russell 2000 Small Cap Index to climb 14% by the end of 2026, as money rotates out of megacap tech into smaller, cheaper companies. Macroeconomic headwinds are also building. Global growth is projected at 3.1% in 2026, slightly below 2025. Inflation remains sticky, and the US dollar is expected to decline. The hype cycle is not new. We saw it with the internet in the late 1990s, with blockchain in 2017, and with clean energy in 2020. Each time, early investors made fortunes, but latecomers often got burned. Yet AI is different in one key way: the hyperscalers funding the boom have real revenue and strong balance sheets. They're not startups burning through venture capital, they're cash flow machines. But market concentration remains the biggest risk. When the top 10 stocks make up over a third of the S&P 500, any correction in those names has outsized consequences. The dot-com crash wiped out $5 trillion in market cap. Regulatory risks are also rising. Crypto firms face heightened scrutiny, and AI regulation is being debated in Washington and Brussels. A sudden regulatory shift could puncture the hype. Geopolitical factors add uncertainty. The US and Iran recently agreed to halt war and restart oil shipments. Trade tensions between the US and Europe continue. These macro shocks can redirect capital flows overnight. So what should investors watch? First, earnings season. If AI companies miss revenue targets, the air comes out fast. Second, Capex announcements. Any pullback from hyperscalers would signal doubt. Third, the adoption of AI applications. If enterprise AI revenue starts to catch up with infrastructure spending, the hype cycle may enter a sustainable growth phase. If not, the trough of disillusionment awaits. The Bloomberg AI Equal Weight Index rose 36% in 2025, outperforming the S&P 500 for a third straight year. That kind of streak can't last forever. Mean reversion is one of the most powerful forces in markets. The hype cycle is real, but it doesn't mean you should avoid AI stocks entirely. It means you need to be selective, patient, and aware of where we are in the cycle. The best opportunities often come after the crash. As the old saying goes, be fearful when others are greedy, and greedy when others are fearful. Right now, the greed meter is high. But the cycle always turns. Stay informed, stay disciplined, and don't chase the hype. If you found this breakdown useful, hit subscribe to stay ahead of the hype cycle. We'll be tracking every twist and turn in AI and tech stocks. Thanks for watching, and see you in the next one.